We have another big guest to bring you right now, Bridgewater founder Ray Dalio. He's got a new book. I don't know if it's a book or really an essay or a treatise.
It's a thing.
Really. And it's called How Countries Go Broke, Principles for Navigating the Big Debt Cycle. And it is going to be available online soon.
It's
not
available.
Already. It's available now.
Yeah. I'm putting it out part by part. It's got 4 parts, and then in about 2 weeks it'll be all out, and it's free on a PDF because people don't know the mechanics, and
right.
government officials don't know the mechanics. And so this went back for 35 countries. What is the mechanics? What is too much debt? How does it
right.
work? How does it end? So I wanted to convey that because it's the most important political issue
right.
that's going to be in front of us.
Let's break it down, because it is very true. We are going to have taxes on the table this year in the United States, and we are going to have deficits on the table, and they're interconnected. How the deficits get dealt with is the fundamental question. You've been studying this stuff for a very, very long time.
Yes, and it's not just an American issue. It's a Chinese issue.
Right.
It's a European issue. It's a Japanese issue. There is a supply-demand issue, and there's mechanics of that. I hope we can touch on those mechanics, but there is a path forward, and whether you take that path forward or not is going to be critical for the bond market.
But let's talk about it. And what is that path? And you're right. I've been arguing, I don't know if you agree, that the bond market, more than anything else, is going to be the governor on all of. If there is a governor on the politics of our moment right now,
that's right.
Given that you have a red, Congress, Senate, and the White House, the only governor, if you will, politically, in a weird way, may be the bond market.
Of course, because interest rates, the government interest rate is the backbone of all markets, right? Stock market, bond market, all borrowing, all lending, everything, right? So in answer to your question of what is the solution or what needs to be done, and it's almost a black and white situation, is think of the number 3%.
3%.
3% of GDP.
Yes.
We have a projected deficit of 7.5% of GDP. Mm-hmm. That means all those bonds have to be sold. And then because of the supply-demand imbalance, when you sell bonds, when I calculate who are the buyers of the bonds, there will not be enough buyers. Right. And then what could be worse in this dynamic is those who own bonds also sell the bonds. Mm-hmm. And when that happens, there's a tremendous supply-demand, and then we have problems. We can get into what it looks like. It's happened many times before. So we have to stabilize that, and we can do it. That's what I call the 3% solution. Okay. 3% solution is that you can cut it down from 7.5% to 3%. Now, what people don't realize is there are 3 ways of doing that. They understand that there are taxes, there is spending, okay. But what happens is, like in 1991 to 1997, there was a comparable decrease in the budget deficit, because if you do it when the economy is good, you will get a lower interest rate. And the lower interest rate means less money on less cost of the debt, because we have so much debt that the interest cost on the debt is more important than spending and taxes. And so you can get there. And if you get there, you'll get a bond market rally.
How do you get there? But how do you get there? Because there's going to be a big question come this summer about whether you extend the tax cuts as they are, whether you make them even lower. Does that help on the growth side? Will you ever make it up on the other side? How do the tariffs relate to all of this?
You know, the biggest problem, I think, is that everybody has their particular way. Okay. So I think it's first of all the members of Congress, all the president should basically say 3% of GDP now, because they have all their particular ways.
But then it's how do you get there?
Okay. First, if you make the pledge. Second, if you can't agree, you would start off. You'd say, I'll do everything proportionately, by way of example. If you did everything as your backup, then you work from there. If you can deliver any form. So, yes, if you can deliver cost cuts, but you have to pledge to deliver those cost cuts. Now, there's smart ways and there are stupid ways,
right,
okay, of doing that. But and everybody will argue over that. But you must achieve the 3. So I think the 3% pledge, 3%, we will do 3%. If we can't even agree on how we do it proportionately, but let's work together on trying to do it. Because our problem isn't the deficit. Our problem is the politics, the fragmented politics.
Let me ask you a separate question, which is, and we've talked about it multiple times during this last 3 hours. Becky raised it at the very, very beginning of the show. We were discussing a Wall Street Journal article that was talking about P/E ratios at the beginning of effectively a presidential campaign, not a campaign, but a term, and just how high they are now, at historic highs, even relative to where they were before Reagan, before everybody. If we are here together a year or two from now, do you look and say these markets, these equity markets, are going to be higher than they are today? They're going to be lower than they are? Do you look at this as a great investing environment, given the backdrop of deregulation and all of the things that the president is saying he plans to do? Or do you say, wow, we've gone pretty far already?
We have gone pretty far already, and particularly in certain sectors and so on. But the biggest influence is going to be what I'm talking about. Because if you have those multiples and you have a rise in interest rates,
right,
okay, you will have a pop.
Mm-hmm.
So as we focus on that deficit question, but yes, of course, it's fragmented. I think that it's, of course, led by the sectors that are great sectors, the disruptors, the AI and so on. I don't think it's been carried down to the applications of AI. In other words, the uses of AI.
Right.
So if you're watching, as I'm watching around the world, and by the way, it's very interesting, what's going on in China with AI in terms of applications, other places. The applications of AI are under-discounted, I think. Mm-hmm. And then, of course, what is the term? What is the multiple? The multiple is an extension of the interest rate.
But that means you would be long this market right now?
No, I have to be diversified. I don't want any particular right now. I don't want to be overextended on an alpha. And also, I would say one thing is, I don't think we think enough about what's alternative money. Mm-hmm. We only think everybody's... Okay, so when you think about...
Give me some alternatives to what's alternative money right now.
Okay, gold is an alternative money.
Right.
Yeah, and it's a very effective diversifier. So if we're dealing with some Bitcoin, debt is money.
Right.
In other words, when you're owning debt, you're owning a promise to get money.
Right.
And when you own money, essentially you're holding it in debt.
You've held it.
And I think that is our biggest risk.
Our biggest risk?
That's our biggest risk. The money part of the risk. There are great things that are going on in innovation and change, but people don't pay enough attention to the interest rate, the PE, but also the cost of it. People have a tendency to think a great company is a great investment without looking at the price.